what could be driving a lot of these growth? So here you've got three charts. On the left, you're looking at weekly earnings, that's how much you earn, right? And this is comparing it to 2019. And you'll see that earnings, and unfortunately we don't see it this way, it's really easy, but earnings are about 25% above where they were pre-pandemic. So we have numbers. When you think about what that's done for RevPAR, there's revenue per available room, or what we might call same-store sales in hotels. That's about 15%. The wages are outpacing hotel top line. And then we've got CPI, inflation, specifically for airlines. As we know, the airlines are offering discounts now. So if you have higher wages and you have discount airfare, you should travel. Another thing that seems to be plaguing people, but it's not terrible, is how leveraged it is, how much people have borrowed on their credit card. So you might be seeing headlines that say consumers are more leveraged than ever before. They borrow more consumers. And it's sort of partially true, but since wages are higher on a net basis, if you compare both how much they've borrowed and how much they've earned, we're about a little bit below where we were pre-pandemic. So again, we should have money to be saving going up. Stock market, the S&P 500, near all-time record highs, which is benefiting those people that participate in the stock market. Unfortunately, that's just a small portion of all consumers, and that's why we're seeing some weakness in the lower end of hotels. Because of course, the people that participate in the stock market are the ones that benefit from the All right, another dynamic that stands to benefit our industry is a recovery in inbound international travel. Americans go overseas than we have foreigners coming into the US. On the right-hand side, though, what you'll see is the growth rate, and the number of foreigners coming to the US is growing faster than the number of Americans going overseas. This is particularly important for markets on the West Coast, where we have yet to see a return of the international traveler from Asia Pacific. So they're seeing some weaker trends. The East Coast, Miami, New York, Washington, D.C., they've predominantly seen a full recovery. All right, so let's take a look at what could drive our forecast going forward. Again, I'm not going to give any forecasts, but what you'll see here is three price tiers: lower price tier, middle price tier, upper price tier. And this is a breakdown of ADR and occupancy. And you'll see over the last 3 months, occupancy, which has been declining, is getting less bad. It's not amazing, just less bad. If things continue to improve, we should expect less headwinds or less drag, and that could be a catalyst for improvement, and I'm sure Ryan will talk about that in a moment. All right, now the bad news. Now we can all get depressed. It was the highlight of your day, now it's about to be the low light. All right, so during COVID, on the right, you'll see there was a huge boon. We all stayed at home, many people got checks, I didn't. I've paid into unemployment for, 40 years and couldn't even get $250 from the government. But to those of you who got it, amen, sister. Anyway, we had over $2 trillion of accumulated savings, and that has all been burnt down now. No more. On the right, you'll see just savings rates also spiked during COVID. Now we're below average in terms of savings. Maybe that's good news for the hotels, right? People are spending every last dime they've got, but it's just not sustainable. Alternatives to lodging are cannibalizing our industry. That is anything from short-term rentals to cruise lines to market share gains taking place in Las Vegas. You'll see hotel room revenue 119% of 2019, and then you'll see short-term rental revenues 170%. Our business is being cannibalized. What is a key differentiator? Service. If you were just offering a box and a bed, I might as well have gone to an Airbnb. All right, another headwind, cost increases. Unfortunately, insurance is up 240% versus prior to the pandemic, which is crazy. And that's going to be more important in certain markets. If you've got a wildfire, if you've got a tornado, if you've got a flood risk, if you've got any sort of climate-related risks, your insurance is through the roof. Property taxes running 134%. And on the right, you can see the year-over-year growth rates with wages, of course, still increasing as well. So expenses are outpacing revenue growth, and that is a headwind to profits. So here, this is a look at margins. What's happening to hotel margins within the property. And you can see that year over year on a trailing 12 basis, they're down 110 basis points. Again, costs growing faster than revenues. That means your profits and margins are declining. Hire a good asset manager. Okay, this is looking at mortgage rates, which is another headwind. This is a headwind to development. This is a headwind to transactions, and this is a headwind to your cash flows. You can see that mortgage rates are up fairly substantially. They're running about 121% of 2019's levels, so it's going to cost you more to borrow money. It's going to be more difficult to finance, and something a little bit more complicated, but you're going to need to put more equity into the deal. I think John is going to talk about this a bit in the transaction environment. And I finally just got a couple of wild cards. This is like, I don't know, is this good, is this bad? I welcome everybody's opinion. All right, so the economy is growing, and it's expected to continue growing. Our forecast for GDP growth this year is 2.3%. That's slightly above the historical average. It's not booming growth. If we only had kind of 2% RevPAR growth or 2.3% RevPAR growth, but we have 4 or 5% cost increases and borrowing costs being elevated, that's still just not good enough. We don't know where GDP will come in. Hopefully it will be better than that, but there's definitely risks. Here we've got two competing factors. Unemployment, the number of people participating in the labor force looking for a job but not having one, has been increasing. Before the pandemic, it was 3.5. We're now at 4.1. And as you can see, this is a time series progression with the black bars being a year. But on the right, the number of people employed is still increasing. So we have increasing unemployment, more people going to work. So competing dynamics. On the left, we have office attendance. It's kind of petered out. How many people going to the office? It's running about 50%. A lot of people working remote. That is good for group travel. People need to get together somewhere like this. And you guys are brave for coming at 8 o'clock. Andy's going to be moving that next year. But on the right, you'll see that we have record corporate profits. So although people aren't going to the office, it's bad for individual business travel, record corporate profits, which means companies can put people on the road for group events. And then finally, we've got an election. On the left, we are showing consumer sentiment, and on the right, we've got business confidence. And what you'll see is that both of them are improving a little bit, if you want to consider meh or wah-wah a little bit. But neither of them are really strong. And now we have an election coming up with two diametrically opposed parties, and I'll leave it to you to decide what that means. But the policies will be completely different, and the implications for our industry are really up for grab. And with that, I'll turn it over to you, John.
Great. Thank you.
He has a button problem too.
Oh, was it? There we go.
No,
okay.
No, I'm just so bad at technology.
Okay, good morning. I'm John Lancet, and I'm the Senior Managing Director of HVS's office here in Miami. I'm going to be presenting transaction trends specifically of limited service hotels. So that grouping is limited service and select service hotels, specifically in the Eastern Caribbean. The Eastern United States. And what I've ended up doing is breaking out the Eastern US into the Southeast, Mid-Atlantic, and the Northeast. I'm going to provide you some statistics. It's interesting based on the information that Rachael just provided to you. You'll see in the stats that I provide to you the real impact that the interest rates have had on the transaction environment and on the sales volume of limited service hotels. So to start here, this is all limited service sales volume within the Eastern United States. And what's interesting, it is, if you see, it is sliding, but if you look at the last 10 years, we're at a pretty decent sales volume. So I've been, recently kind of bifurcating and analyzing sales transactions between full service and limited service hotels. Again, this is just limited service. And I have seen that limited service sales volume is starting to surpass the sales volume of full service hotels. One thing to note here, this data is specifically just for individual properties. It doesn't include any portfolio transactions. So overall, the volume is down about 18% compared to last year. The average price per key is about $98,000 in the Eastern United States. Wow. And the cap rate is about 8.2% on average. Bear in mind that that average price per unit that's net, right? So it's not including, and there's no adjustments there for potential additional PIP costs that would follow the transaction. Now, this is specifically for the Southeast. So historically, if you look historically over the last 10 years, yes, we are sliding, but the sales volume for limited service hotels in the Southeast is still high if you look at over the last 10 years. And volume in the Southeast, we're also down about 18% in volume. Our average price per unit is about $94,000, and the average cap rate is 8.7%. Now, this is for the Mid-Atlantic. Mid-Atlantic is starting to slide a little bit. Okay, it's definitely below some of the historical highs over the past 10 years. The average price in this particular geographic area for the Mid-Atlantic was about $80,000 a room, and the average cap rate was 6.7%. So what I really want you to take away from this is look at the difference between that cap rate that I provided to you in the Southeast compared to the Mid-Atlantic. So as you explore, opportunities, bear in mind that there are specific regions have impacts on cap rates, and I urge you not to just generalize the statistics and dig in deep into the specific markets you're looking at. And then this is for the Northeast. Again, it's starting to slide. Historically, though, we're pretty high, but it is a little bit lower than the peak that, or the last high that was about in 2015. Average price per key for limited service in the Northeast is about $136,000. I didn't have enough data to extract the cap rate for that region, but overall sales volume is down about 15% for that region. And I wanted to provide you with like key markets where the volume is in 2024 so far year to date. So for the Southeast, the top markets are Atlanta, Miami, Tampa, Orlando, and Charlotte. For the Mid-Atlantic area, it's the DC Metro, Philly Metro, and Harrisburg, Central Pennsylvania. And for the Northeast, top market is the New York City Metro, Boston, and Albany. There's my contact information. The presentation will be made available for you. And if you have any further questions, please let me know. Thank you.
Focus on geraniums, if you would.
All right.
Okay.
I'll focus on geraniums for Mark.
There you go.
Thank you, guys. I think those were great. It's never easy to follow the presentations from two people like John and Rachel, but I will do my best to not disappoint as we talk about geraniums. No, that being said, we're going to walk through real briefly kind of some of the economic outlook. Rachel actually touched on a lot of the points that I like to highlight, so I don't have to go through them in great detail. Thank you, Rachel. We'll then walk through our lodging outlook, and then I'll talk about some of the market highlights across the US. And then we're going to dig in a little bit on a specific market, give you some kind of insight into how we think about them and build out our forecasts, et cetera. I think that might be helpful for some of the people in the room. So that being said, when we think about our economic outlook, we really tend to focus on the core demand segments of corporate transient, leisure transient, and group, because they all obviously have an impact and they're driven by different factors, right? So one of the primary things that we tend to focus on with corporate transient is the, quote, return to office, right? How many people in here think they're in the office as much as they were back in 2019 today? I think we got 2 or 3 hands, right? The reality is there's a lot of headlines about companies coming back to work, forcing their employees to come back to office, all those types of things. These headlines, these are just 4 of them that we identified over the past couple of months from major media articles. The reality is, while that may be true, and we can find dozens more over the past couple of years, as Rachel pointed out, we've seen things basically stabilize at around 50% of pre-pandemic levels, according to Castle Systems. That's not necessarily the perfect metric. Castle's data isn't end-all, be-all, but the bottom line there is it's not changing. We're not seeing an acceleration despite all these headlines. Things seem to have normalized at a lower level than where we've been before. Why does that matter? If there are fewer people in the office, it means you don't need to travel to visit those people in the office, and therefore less corporate transient demand. And that's what's weighing, that's one of the things that's weighing on the industry. Second thing that we'll highlight that Rachel mentioned, corporate profits and stock market values are well above pre-pandemic levels. Stock market's 62% above 2019 levels. Corporate profits are expected to be over 30% above 2019 levels this year. So when you think about that, those are some of the primary drivers that drive corporate transient demand. When companies have more money to spend, they're trying to grow into their earnings multiples, they're trying, they want to justify, they have the capital and want to justify valuations, they spend more, right? And that spending leads to more corporate travel. So that points to upside, but like we said, there's a big headwind, or at least lack of a tailwind tied to people in the office. So we see plenty of upside in terms of where things can go. Even if we see corporate profits decline or the stock market fall, it doesn't necessarily translate into a pullback in corporate transient demand going forward because of where we are relative to the historic baseline. So we're a little bit optimistic that corporate transient demand will continue to gradually improve. But we're not seeing this big inflection point that, oh, now corporate transient is going to be back up 10, 12% and recover to pre-pandemic levels. We think that ship has sailed. Shifting to group, we track the 30 largest convention centers across the US. Convention centers have a huge impact on overall group bookings, and they impact citywide events, which impact all hotels, not just the hotels immediately around the convention center or big hotels like this one. 2023 convention bookings were up 14% year over year. That was heavily skewed to the first quarter, but still really positive. This year we're also positive, up about 4%, which is also encouraging. Should be a nice tailwind for this year. However, next year we're pacing down 3% year over year. That's a slight headwind. The good news about that slight headwind is we think that headwind is largely tied to uncertainty surrounding the presidential election that's caused kind of a pause in group bookings, which will likely get resolved post-election in November. And then we could see a snapback and get things more aggressive. I'm not saying that 2025 is going to be a positive year, but it may not end up being a meaningfully negative year for group bookings. And when you think about markets that are really strong from a group perspective, Seattle stands out as the strongest for this year. DC is really strong, San Jose, Charlotte. Weak markets, San Francisco, Boston, Austin, Tampa. Moving on to leisure. I'm not going to spend a lot of time here because I think Rachel hit it home pretty hard, but an unhealthy U.S. consumer appears to be here. Retail sales growth was flat in June. I believe it was flat in May. We've seen basically declining trends for retail sales. The Visa spending index has been really soft. The discretionary spending index has been really soft. Those aren't encouraging. If you look at the Deloitte Consumer Spending Intentions Index, while you see an uptick for leisure travel there, it's still below where it was a year ago, and the uptick over all 6 months year to date are below where they were over the 6 months last year. That points to the challenges that we're seeing from a leisure perspective, and we're continuing to see that. And those are things that get us cautious about the consumer. And then, like Rachael said, personal savings rate is a big issue. Believe it or not, and this is something that I think is always worth highlighting, there is a negative 86% correlation between the US personal savings rate and the share of wallet US consumers allocate to hotels and food service, right? You save more, you spend less on leisure items like travel, right? You save less, you spend more on things like that, right? Well, guess what? Interest rates are high, encouraging people to save more. Our savings levels are relatively low versus historical levels, so that encourages people to want to save more. And there's a tremendous amount of uncertainty tied to the economy and the political environment, all of which encourages people to save more. That tends to translate into spending less, and that's what you see in the forecast there from Moody's Analytics. It's forecasting personal savings to tick up over the next couple of years, which is going to add further challenge to what we call domestic leisure. Sorry to disappoint, but there's a little bit of a silver lining. Like Rachael mentioned, international outbound travel has been a big challenge. We're seeing a tremendous amount of pent-up demand for travel abroad from US citizens. That's what you see in the top line there on that chart, well above pre-pandemic levels, and the trends seem to be pretty strong and holding. Inbound foreign travel from foreigners coming to the US last year was actually about 16% below pre-pandemic levels, but we're up 10% year over year. Trends are generally improving, and we think that will continue to improve, and that's encouraging. And the reality is, as we move forward, hopefully that top line will start to moderate or at least stabilize, more likely to stabilize than moderate, but that's encouraging. And this kind of also points to the idea that those with means to travel abroad are choosing to travel abroad. Those without the means to travel abroad are generally not choosing to travel or spending much less, which is just worth highlighting. So why will this change going forward? One of the primary drivers is foreign exchange rates. So the dollar, when the dollar is high, it basically means that US destinations are really expensive for foreign travelers, and foreign destinations are on sale for US travelers. When the dollar is low, the exact opposite occurs. Well, if you look at 2022, 23, 24, and the first half of 24, the dollar was increasing at various levels, but it was all going up. That doesn't incentivize people to want to book travel to the US, and it does incentivize them to book travel abroad. The expectation earlier this year was going to be a free fall in the dollar, because largely driven by the expectation that the Fed was going to start cutting rates sooner, and that has a very strong relationship with the strength of the dollar. Obviously, the Fed hasn't cut rates. Things have shifted back. The expectation now is that the Fed's going to start cutting rates later this year, and you see later this year kind of a free fall in the dollar, dropping down through 2025 and into 2026. If that happens, that should make US destinations more attractive for foreign travelers and US travelers. And that's encouraging. Whether it happens, we'll see. This is the forecast from Moody's Analytics. Hopefully it does play out. But when you think about foreign travel, one thing I'll say is not every market is the same. Lots of markets have different exposures. You can see Miami's got tons of exposure to foreign travel, as does New York. Markets vary, and it's not just the exposure you want to pay attention to, it's also the pace of recovery. Markets like Dallas and DC were fully recovered to pre-pandemic levels in last year, whereas Honolulu was still 50% below 2019 levels last year. So understanding those nuances is really important. Last thing, as Rachael mentioned, presidential elections kind of important. So we focus on the last 6 elections because we think since 2000 is when the political landscape of the US has gotten increasingly polarized, where you don't have as many centrist candidates and the candidates move further left and further right, and therefore the bifurcation of outcome becomes more meaningful. As you see that type of uncertainty in an election year, it translates into performance. So what you're looking at in this table here is the change in growth rates for GDP, business investment, hotel demand, and RevPAR in the election year from the prior year. And what you'll see is that for GDP and business investment, in 5 of the last 6 election years, you have seen growth decelerate from the prior year. Hotel demand and RevPAR, in each of the last 4 election years, we have seen growth decelerate from the prior year. We expect that to have a big impact over the next few months leading up to the November election. But then usually coming out of the election, you see a pop. And that's encouraging for late 2024 and really early 2025, which is just worth noting, realities of the situation. This just gives you a quick overview of our economic drivers, which I'm not going to go into, but you've got it in the slide deck. Moving on to our lodging outlook. Corporate transient, I talked a little bit about that. We think corporate transient stabilizes well below where it was in pre-pandemic levels. 2024 is a bit of a stabilization year. Still decent growth, but not aggressive growth. Group is really positive. It's going to be one of the big tailwinds that we get coming out of the pandemic is more corporations are choosing to spend money on conferences and conventions, sending more people. That's really encouraging. We're seeing, and that has to do with the fact that their teams aren't in the office as much, right? They're not together as frequently, so they're trying to get them together, whether it be in-house, corporate meetings or sending more people to conferences and conventions like this. Ultimately, we see group continuing to pick up, as we talked about with that convention booking pace. Every year but 2025 is meaningfully positive on a year-over-year basis through 2028. And then leisure transient. Leisure was the big winner coming out of the pandemic. We all know that, right? Everybody traveled abroad, spiked up. It has gradually pulled back. We think 2024 is the last year of a meaningful pullback in leisure travel, and things will start to normalize. But net leisure relative to pre-pandemic levels is clearly the big winner. Just something to keep in mind from a growth perspective. Supply, we generally don't view new inventory and development as a huge challenge for basically any market we forecast for. Supply growth in general is relatively muted. Don't get me wrong, there are some exceptions and there are submarkets and property types where you're going to see a lot of supply growth. But across the country as a whole, supply growth is relatively muted, and it's not driving our views to the extent as our views on demand. Moving on to our model, this is to give you an idea. For those of you that remember your stats class from college, this is the backtesting of our RevPAR forecast model. You can see the accuracy of it historically, what the R-squared is, and the primary drivers of that model. Same thing for ADR that you see right there. And then we put it all together to our quarterly forecast. Now, what I'll highlight about this quarterly forecast is we have pulled through STR's final 2Q results, which came in a little bit lighter than where we were. And as we pulled those numbers through, it lowered our full year number. That full year number, we have not adjusted our forecast for 3Q or 4Q yet. That'll come out in about a month. But it just kind of pulling through those numbers basically drops our RevPAR growth for 2024 about 20 basis points, just from where 2Q came in a little bit lighter. A couple things to note about this year. 2Q was our strongest quarter. That's tied to the Easter calendar shift, as well as the eclipse and some other factors going on there. We think 3Q will benefit meaningfully from the Jewish holiday calendar shift, where the Jewish high holidays are moving into, all of them are moving into October. That creates more group demand in late September than you would normally have, and then that becomes a headwind in the fourth quarter in October. Then 2025 1Q, we talked about that pent-up demand as people aren't traveling as much going into the election becomes a big tailwind for the first quarter. You also have the benefit of softer comps tied to that Easter shift that happened earlier this year. But net, the good news is we actually see an acceleration in RevPAR growth next year, which I would normally say is super exciting and really encouraging. The challenge is it's still not overly aggressive growth. And that's kind of where we're at in terms of our quarterly top line forecast. When you think about price classes, if you think about it, bifurcating it by the type of demand segment, we talked about we're very positive on the group segment for 2024. That's where you're seeing upper upscale and luxury perform particularly well. We think corporate transient continues to improve, as well as inbound international. Again, upper upscale and luxury tends to benefit. Domestic leisure demand is the segment that we think is struggling the most this year. We think this is the year that kind of resets, and then things will be better next year, we hope. But that's the economy and mid-scale segments that will continue to lag. Expenses and EBITDA, here's our forecast for expenses and EBITDA. Wage growth, we've got an estimate of about a 3.2% compound annual growth rate over the next 5 years on wages per employee. Now keep in mind that includes the idea that there's going to be some cost synergies as we truncate some of our expenses across the market, leveraging technology in different ways, AI, other dynamics that get built into that number. So it's not an hourly wage growth change, it's a cost per employee change and overall wages. And then property taxes will grow at about a 4% CAGR. We think, as Rachael pointed out, factors like property taxes and insurance, the massive increases that we saw coming out of the pandemic, we think that's mostly behind us now and things start to normalize. Hopefully we're right on that. But a lot of what we're hearing from the owners we talk to and we work with is that that is the case. But remains to be seen. Property taxes, obviously every market is different and you can see massive changes. Insurance costs, obviously every market is different. You can see some massive shifts. But when you're looking at roughly 2.5% expense growth, that translates into EBITDA growth that is slightly positive most years moving forward, with a slight negative in 2026. And we put it together and it gets you to our overall outlook for values. This year we see values increasing about 4%, and that's largely fueled by positive EBITDA growth, coupled with the expectation that interest rates are going to moderate. Whether that happens or not is another story. We're not necessarily of the view that it does, but sentiment shifts will drive cap rates slightly lower, and that's encouraging. But in the years that follow, as interest rates stabilize well above historical levels, we don't necessarily, and EBITDA growth is muted, we don't see that translating into strong value appreciation. There will be modest value appreciation, largely tied to cash flow growth, not tied to cap rate compression. Let's talk about markets real quickly. These are the 62 markets that we issue quarterly forecasts for. We'll highlight a few things here. First of all, if you think about 2024, think about everything we talked about. Our strongest growth markets tend to be those that have outsized Asian, international, foreign travel, corporate transient demand, that's improving, and/or have strong convention paces. Weakest, those that are predominantly cater to domestic leisure demand and have weak group booking paces. You know, plain and simple, everything that we talked about earlier kind of unfolds there. If you take a longer term look on RevPAR growth, our top performers have soft comparisons or strong markets going through major shifts. Places like Las Vegas, where you're seeing just a massive transformation across the market. Palm Beach, where you're seeing massive corporate growth that wasn't there before. Or Puerto Rico, where you've got a massive energy infrastructure that's transitioning that market in a very positive way. Or other markets that have outsized exposure to leisure and strong macroeconomic factors. Bottom performers tend to lack material international travel demand, have sluggish economic growth, soft convention calendars, or tough comps. And then when you think about values specifically, I'll just highlight some of our three favorites. Puerto Rico and Las Vegas I mentioned earlier. We think there's huge positives there. Seattle's a market that we think is misunderstood, and we really like it right now. When you talk about contrarian views, I think that's one where we have a bit of a contrarian view. Bottom performers tend to be those that have soft convention calendars. Places like Austin, where the convention center is going to be closed for 5 years. Difficult comps like Boston and San Diego, or elevated expense growth like a Chicago. And then just digging in a little bit deeper, we have an application we call LARC GIS, which instead of forecasting at the market level, gets down to the census block group level. There are 217,000 census block groups in the US. So we're talking super granular detail. And I'm going to focus on Seattle here because, like I just mentioned, it's a market that we like, that we think is a little bit out of consensus. Strong economic growth across Seattle, top third of all the markets that we cover. Not a lot of supply growth, only 463 rooms under construction in the entire central business district. International inbound recovery is really, really strong there. Through year-to-date April, we're up 18% year over year and back to 2019 levels already. That is not the same story as you hear about LA, San Francisco, or Portland, right? But it gets ultimately lumped in with all the other West Coast markets. We think that creates some disparity. And then you have a massive convention center strength. They completed a $1.9 billion convention center expansion last year. Strongest pacing in the country this year, as I showed earlier, up 37%. The coming years aren't nearly as strong as that, but it's still positive, and we're pretty encouraged by where that is going. Our Seattle RevPAR model looks like this. Again, high R squared, you can see the accuracy historically, the factors that drive it. And then our GIS application, what's cool about this is you can actually drill down into the specific locations within the market, within the submarkets. And one of the things that this highlights, if you basically drew a circle around that central business district, our RevPAR forecast for that area over the next 5 years is a 9.0% compound annual growth rate. That is unbelievable when we're talking about 2.5 across the US. But there's a big difference between what we're seeing in the CBD, where you see a lot of those dark blue, versus over the other side of the bay, where you see a lot of the light blue. Light blue is much lower growth. That's Bellevue. We're not nearly as positive. That doesn't benefit from the convention center, doesn't benefit as much from the inbound foreign travel. All the other factors that we just talked about tend to be more skewed to the left side of that screen than the right side of the screen, which is just kind of interesting as you look at, don't just assume everything in Seattle is going to be great. There's going to be submarkets that matter and locations that are way better than others, and that's what we do. Where we can really hone in on individual locations, even give you a score for any development site you're looking at. And then last thing I'll say about Seattle is if you look at our actuals versus some of the other guys that issue forecasts, our forecasts going into 2023, we forecasted RevPAR growth of 10%. The other guys were around 17%. It came in around 8%. First quarter of this year, going into the year, we forecasted 11. The other guys forecasted 23. Came in around 9, and you can see where we're looking at for the full year. So again, our forecasts have historically proven to be more accurate than some of the other guys. And with that, I'm going to stop. I think Andy's going to make sure presentations are available, but if anybody wants to get a hold of it before Andy makes it, you can just email us at information@larkanalytics.com, and we'll hand it over. And now, Mark.
Okay, thank you. Thank you, Ryan. Jeremy, do you have your question ready? Or did Jeremy leave?
He's smart. He knew everything already.
Huh?
Jeremy's smart. He knew everything already.
Yeah, good point. Well, first of all, thank all three of you. That was terrific. I have I guess many personal biases, but one of the ones I exhibit at this particular gathering is wanting to acknowledge the number of students that are here. And I would encourage all the students that are here to ask us any questions that you'd like, either further discussion on something that was just addressed by one of our speakers or something that we didn't cover, or just anything. And to maybe stimulate some thoughts, I've asked each of our three panelists that if we were in the student's shoes today, and maybe we're a year away from graduation, getting ready to launch our careers and so forth, I guess, would you be happy? Would you be sad? Excited? What kinds of opportunities do you think would be a good starting point to launch your career? I guess, John, I'm going to put you on the spot first, if that's right.
I found it interesting when I heard Rachael talk about NOI and margin levels, and she said, get yourself a strong asset manager. I think that asset management, there's a lot of supporting roles in the asset management space, and I encourage students to kind of explore the opportunities that might be there. The other thing I urge the students out there to pursue is mentorships. I think, I'm on one of the boards at my alma mater, FIU, and I'm involved with mentorships and internships there. And the days of having a mentor that holds your hand for a year or three and kind of walks you through the steps are it's difficult. So what I've encouraged our board to explore is having mentors provide blocks of time as opposed to a full commitment of a mentorship. And I just bring that up because I do think that mentors have a meaningful impact to your future, and I encourage you to explore what mentors may be available for you. There's a question out there. Yeah. Yeah, go ahead.
Go ahead, yep. Yeah, you got it. Go ahead and stand up so we can hear you better.
Can you yell? Sorry,
Yeah,
it's a little
it's kind of hard
to
to hear.
hear.
Come on up front. Or you got the, okay.
Thank you. All right, so I was saying it's a very comprehensive presentation, very informative, but I wanted to ask a question, two questions, but I'll put them in one. So what I got from the presentation, especially the second one, is that there are a lot of downward trends due to the pandemic, but slow growths are expected. So I wanted to know what plans are in place for both the short term and the long term going forward to see if there can be any further growth.
What opportunities are available to spur additional growth? Is that the question?
Well, not so much opportunities, but more so the plans. What are the plans going forward? You know, what can people say, or what can be done to increase profitability, increase revenue, and even opportunities where that's possible as well? What?
In terms of career opportunities?
Well, yeah.
I think he means in the asset. Or do you mean at the hotel?
Well, in general, really, in general.
In general. Okay, well, if in terms of, again, careers, John, I think you spoke to that in terms of asset management and also the value of having mentorships and so forth. As an aside, and maybe, Rachel, I'm going to ask you to kind of give your answer next, but another one of my biases, and it's a great concern, and all three of you touched on it to some degree, is this return to office phenomena. I mean, I can tell you many years ago when I was beginning my career, I learned one heck of a lot about how you do what you do and what the people that seem to be progressing quicker than others and those that seem to be lagging behind others, how do those folks behave? And so you learn good stuff and you learn some stuff that you probably don't want to do and so forth. So maybe just touch on any concerns you have about people starting out and oftentimes don't have the opportunity to go to the office, and what concerns, if any, might that you have about that?
Well, personally, in terms of how I started out as a short order cook and a housekeeper at the Algonquin. So you can start anywhere. I grew up in a housing project with a single mom, all the things. And I went on to pursue a PhD in econometrics, and I have a graduate degree in hotel administration from Cornell, and a CFA and an ISHC and a 40-year career and all the things. So just get in the swim lane and start swimming and don't look back. I will say in terms of risks, like I grew up in an era with no social media, so no one cared that I was washing dishes and flipping burgers. Like you have to drown out the noise. What other people think and what other people are doing does not matter. That is complete garbage. In terms of not going to the office, and I'll put myself at the front of the line in terms of like captain, I won't say an expletive, but I'm probably your worst nightmare. The people, we're globally remote, and I spend more time with my people than my boss ever spent with me because we're sharing a screen. And so for 8, 10, 15 hours a day, I'm in their face going, not there, here, not there, here, no divide there, no, you want to do this because of that, over and over and over. So they are getting detailed mentorship in a way that I never got. When I was at Morgan Stanley, which was my first Wall Street job, my boss is like, excuse me, I'm going golfing again and again and again. And again, that guy didn't teach me squat. It was do it on your own, fight it out on your own. And Celeste, who's here with me, we both had a very similar experience. She was pulled out of Morgan Stanley, or out of Merrill Lynch on a stretcher with double pneumonia. I missed my engagement party. Like, these people did not spend any time with you. I think remote is the best for training, but it's important to have the right mentor. It's not about whether you're in the office or you're remote. It's about who are you working for and how invested are they in teaching you.
Interesting to segue, Ryan, to you, because my first job many years ago was I was in charge of maintaining the geranium flower box at the little motel, and I mowed the lawns as well. That's how I got started. But your thoughts, Ryan?
Yeah, look, I mean, I think I'll talk about a couple things here. First of all, you know, to piggyback on what, you know, the initial question, I think for students, when you're looking at opportunities, first and foremost, the hotel business is an operating business. There's a reason why Rachael started off working at the Algonquin. I started off working in operations as well. I think you have to understand the operations, and the way to do that is to work in hotels. Very few successful hotel people on the real estate side of the business that have moved up to, you know, the higher levels of the industry don't have some level of experience working in operations. So whether that be internships or full-time, that is certainly where I think the careers need to start, or should start, in my opinion. The second thing I would say is that as you look to transition to kind of the more real estate side of the business, what John mentioned, I think asset management is going to become more and more critical. When we're looking at a relatively low growth environment, you have to learn to differentiate yourselves. And asset management gives you some of those tools and those skills to see how you can position hotels a little bit differently, as well as revenue management along the same lines. In terms of return to office and some of those dynamics, I have a little bit of a different view than Rachael. I think everybody's different, and I think a lot of it comes down to, you know, how we all work and how we operate. I tend to find that training is done best in person, and the connections that you build. When I'm sitting next to somebody and they're working on a task, it's a lot easier for them to ask me a question about it than when they have to pick up the phone, pick up the Teams or Zoom. Hey, can we have a call? They're more, you know, so from my perspective, we like to train in person. The more people, you know, and when we hire new hires, we basically say we expect you to be in the office 5 days a week for the first 6 months. Once you're trained, we afford a tremendous amount of flexibility. But training, I think, in my experience, has always been better in person. Rachel's obviously had different experiences, and she's probably figured out ways to work with her team that works well for them. I have not figured those ways out yet.
It's hard. My team spans Chile, like down in South America, to Singapore.
Yeah.
What am I going to favor just the people that are near me? Like that, it just doesn't work.
Yeah.
But again, you know, I think you have to adapt your style to who you're leading. And I know that I'm also a royal pain in the butt. So, you know, I don't even ask people, do you have time for Teams? No, I'm like, beep, 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 beep. Yeah. But back to John's point and your point on mentorship, like, if you invest in people, they stay with you. Celeste and I have been together since, I don't know, 2002. Christine and I have been together since 1999. Catherine and I have been together since 2009. Like, we move together as a block. Why? Because we invest in each other, we trust each other, and that's how a career is built.
Great. Other questions? Yeah, can you speak up if you would? Yeah, oh, yeah.
I want to say thank you for coming to speak to us today. I'm Omar Caraballo. I go to the Cornell University Hotel School of Hotel Administration. And I had a question specifically for Rachael about, you talked about occupancy getting less bad. And I want to know, like, you touched on the other question about growth for opportunities. So I wanted to know what the hotel industry could do to better increase it.
I mean, to me, I think, and I'm not sure, but I think the hotel industry is moving to two diametrically opposed angles. We could call it like a barbell approach to the industry, which is going to be hotels with next to no services and next to no amenities, and those that are either fully serviced and fully amenitized. Because again, if you're sort of caught in the middle, it used to be when I was younger, whatever, 40, not exactly young, but you would go downstairs and you would have an overpriced meal in the hotel restaurant, and my company would pay for it, and it would be crazy expensive for basically not that good food. Now I can Uber Eats something to my room, or Grubhub, or Seamless Web. Each asset, each amenity within the asset has to earn its right to be there. Like, I don't need to go to a mediocre restaurant and have my company pay $125. I can get something delivered to my room for $35. I don't necessarily need to use room service either. And so as the restaurants begin to be less and less profitable because they have higher food waste and worse service and the experience is worse, they begin to shut them down, or they go to grab and go. And that might be okay for profit margins, but it's not great for the atmosphere in the hotel. And if you don't have amenities and you don't have service and you don't have a differentiated experience, I'm sorry, but people are going to go to a short-term rental. And so I think you really need to find a way to either be profitable in the lower budget end of the spectrum, or you want to be totally blinged out, amazing experience, super differentiated. Those things in the middle, if you're not a group house and not a convention hotel, I think you're going to find it challenging. That's just my personal opinion.
Okay, since I'm, another question? Yeah.
For the last 50 years, the U.S. currency has been known as the world currency. And now that Saudi Arabia has decided not to proceed with renewing the contract, how do you feel the U.S. being a world currency, no longer being a world currency, is going to affect the hotel industry?
That's a tough one. You know, I think that right now, Saudi Arabia is not the only country that relies on the U.S. as kind of their benchmark. Pretty much all of Latin America does. Yeah. And that is not likely to change anytime soon. If you look at hotels anywhere in most of Latin America, you know, they're priced based on a peg to the dollar. So you don't necessarily see the U.S. going away from that. That being said, the political landscape continues to change and evolve, and there's a lot of political dynamics from a foreign policy perspective, with the rise in the Chinese economy, rise in the Indian economy, rise in the Brazil economy, other dynamics, in Europe, et cetera, that create a lot of uncertainty surrounding that. So I don't want to sit here and tell you that 10 years from now the U.S. dollar is still going to be the global currency. It may not be, but I don't think Saudi Arabia's choice is transitioning anything meaningfully globally. That being said, if or when that does happen, it's probably a negative. It's a negative from an economic growth perspective, which obviously is a big driver. GDP growth is a primary factor that drives U.S. hotel performance. It may not break down at the market level, but at the national level, there's a very, very strong relationship there. And if the dollar isn't kind of the bellwether across the globe, then that's probably going to have an impact on overall economic growth, which would be negative for the industry.
Okay. Unfortunately, Ryan, thank you for that. We're out of time, but thank you for your attention, and please join me in thanking our panelists.
Thanks for having us.
That was the 2024 Industry Review and Outlook. Thank you to R. Mark Woodworth, John Lancet, Rachael Rothman, and Ryan Meliker. Our next session is the